Imagine you are a farmer in the English countryside. It is July 25, 2026, and after weeks of scorching heat, your crops are failing. Traditional insurance? Too slow, too disputed, too expensive for your operation. But what if a contract you purchased for a few pounds earlier this summer had already triggered an automatic payout the moment temperatures crossed a defined threshold, depositing funds straight into your digital wallet, no claims form required? That is the promise of tokenized weather derivatives. And today, a major analysis from CoinDesk is making the bold claim that this could be crypto's single most important real-world use case. Not NFTs. Not meme coins. Not even stable coins. Weather. Let us explain why that argument is far more compelling than it might first appear, and why the financial world is paying close attention right now. Weather derivatives are financial contracts that pay out based on measurable weather outcomes rather than physical damage assessments. They have existed in institutional finance since 1997, when Enron and Koch Industries traded the first contract of this type on the Chicago Mercantile Exchange. A ski resort might purchase a contract that pays out if snowfall drops below a set level during January. An energy company might hedge against a mild winter, reducing heating demand and therefore revenue. The global weather risk market processes billions of pounds worth of contracts every single year, yet the vast majority of businesses and individuals who face real weather-related financial risk have absolutely no access to these instruments. The barrier is not demand. It is access. Traditional weather derivatives require institutional brokerage relationships, significant minimum capital commitments, and specialist legal support. For a small farm cooperative or an independent market trader, that door has simply never been open. Tokenization changes that equation entirely. When a weather derivative contract is represented as a digital token on a blockchain, it can be divided into small fractions, traded on open markets, and settled automatically by a smart contract the moment weather data confirms the triggering condition has been met. The parallel to equity markets is instructive. Before fractional share trading existed, retail investors had to buy whole shares, which excluded large numbers of people from participating. Fractional ownership opened that door. Tokenization does the same for weather derivatives, removing minimum investment thresholds and geographic restrictions simultaneously. A farmer in Lincolnshire, a tour operator in Cornwall, or a market stall holder in Birmingham could all purchase tokenized protection tailored to their specific weather risk, paying only for the coverage they actually need. The technology stack required, including blockchain infrastructure, smart contracts, and real-time weather data feeds, is now genuinely mature enough to support this at scale. Today, on July 25, 2026, CoinDesk published analysis arguing that weather derivative tokenization represents a category entirely unlike previous crypto applications, because it solves a genuine and pre-existing problem rather than inventing a new speculative one. The infrastructure to support it is already being assembled. Decentralized Oracle networks have become the critical link in this chain. These systems pull verified weather data from meteorological stations, satellites, and Internet of Things sensors across the globe, then feed that data directly into blockchain smart contracts in a tamper-resistant format. The key word there is verified. Earlier parametric products struggled partly because data disputes between insurers and claimants were common and costly. A decentralized Oracle network drawing from multiple independent data sources resolves that problem structurally rather than legally. Meanwhile, Layer 2 scaling solutions have driven blockchain transaction costs down to fractions of a penny, making small-value weather contracts commercially viable for the very first time. The practical impact of this right now is most visible in agriculture. Across the United Kingdom, farmers dealing with an unpredictable summer in 2026, swinging between heatwaves and sudden heavy downpours, face real and immediate financial uncertainty. Conventional crop insurance covers physical damage but involves lengthy assessment processes, adjuster visits, and frequent valuation disputes that can take months to resolve. A parametric tokenized contract removes all of that friction. When a defined weather threshold is crossed, the payout triggers automatically. No paperwork, no site visit, no argument. In developing economies, where traditional insurance penetration can be as low as 3% of the population, the implications are even more profound. Smallholder farmers across sub-Saharan Africa, Southeast Asia, and South America, who collectively represent hundreds of millions of people and enormous global agricultural output, currently have almost no financial protection against weather events whatsoever. Tokenized weather derivatives, accessible via a basic smartphone, could genuinely change that. What gives this use case particular depth is how naturally it aligns with cooperative principles. A cooperative is defined as an autonomous association of persons united voluntarily to meet common economic, social, and cultural needs through a jointly owned and democratically controlled enterprise. This is a bottom-up structure built from the ground up by its members, not imposed from above by central institutions. Tokenized weather derivative platforms could be structured precisely in this way. Communities of farmers, fishermen, or small traders could pool their weather risk collectively into a shared fund governed by blockchain-based voting. Token holders could set the parameters, choose the data sources, and resolve edge cases, all without a central authority making unilateral decisions on their behalf. This model is fundamentally different from how traditional financial derivatives markets operate, where gatekeeping by large institutions has been the defining feature. It is also the clearest possible expression of what decentralized finance was originally designed to achieve. It would be misleading to present this opportunity without acknowledging the real obstacles standing in the way. Oracle reliability is the most critical technical risk in the entire system. If the weather data feeding a smart contract is wrong, whether through sensor failure, network compromise, or deliberate manipulation, payouts could be triggered incorrectly or legitimate claims could go entirely unmet. Either outcome would destroy the trust that this market depends on. Regulatory uncertainty is equally significant. In the United Kingdom, the Financial Conduct Authority is still actively developing its framework for tokenized financial instruments, and until that framework is established and clear, institutional capital is unlikely to flow into the space at meaningful scale. There is also the persistent challenge of basis risk, the gap between what a parametric index measures and what a specific claimant actually lost. These are serious problems. But they are solvable engineering and regulatory challenges, not fundamental arguments against the concept itself. Looking ahead, the conditions for significant growth are clearly present. The tokenized real-world asset market is expanding rapidly across multiple categories, from government treasury bonds to commercial property to physical commodities. Weather derivatives represent a logical, well-defined, and demand-driven addition to that landscape. More importantly, the underlying driver of demand, climate change, is not going away. As extreme weather events become more frequent and more severe in the years ahead, the economic need for affordable weather risk protection will grow proportionally with those events. The businesses, communities, and smallholder farmers who stand to benefit most are also, by and large, the ones currently least able to access the traditional instruments. That is a market gap with genuine social weight as well as commercial potential. As Oracle infrastructure matures, as regulation catches up, and as the first successful tokenized weather contracts build demonstrated public trust, this could become one of the defining financial innovations of the next decade. The conclusion is clear. The crypto industry has spent years searching for proof that blockchain technology can solve real problems for real people, not simply generate new speculative instruments for traders chasing short-term returns. Tokenized weather derivatives represent one of the most compelling and concrete answers yet to that long-running search. They take a proven institutional instrument with decades of established demand and make it accessible to everyone, from a cooperative of smallholder farmers in rural Kenya to a festival organizer in Yorkshire worried about rain. They use the core strengths of blockchain, including transparency, automation, and permissionless global access, to address a genuine and pressing problem that the existing financial system has failed to solve. Today's CoinDesk report, published on July 25, 2026, puts that argument into sharp focus for the entire industry. If you are tracking real-world asset tokenization, decentralized finance, or the future of parametric insurance, this is a space you need to be watching very closely. Thank you for watching, and subscribe now so you do not miss our next deep dive.